am one of the board. Thank you for that recording. My name is Megan Newman. I am one of the board members for the ACC San Diego Chapter Board of Directors. I also act as Associate General Counsel at Vistage Worldwide. I just wanted to welcome everyone in today. Thank you for being here, and to thank our sponsors, Gunderson Dettmer, who are going to be giving our presentation today on M&A updates, trends, and tips. Wanted to introduce who we'll be hearing from today. Ryan Gunderson is a partner at Gunderson Dettmer. John Olson, who's a partner at Gunderson Dettmer. Eric Steyer, Senior Vice President and General Counsel at Singular Genomics. And Jennifer Sales Ocorn, partner at Gunderson Dettmer. And with that, I will turn it over to all of you.
Yeah, thanks, Megan. Appreciate it. Maybe before we get started, I'll just give a quick intro on our firm, and then we can go into the presentation. So we're the preeminent law firm for the innovation economy. We have decades of experience representing high growth companies and venture financings, M&A, IPOs, and throughout public company life. And we are the #1 most active law firm for venture capital financings all the way back since 2014. And are one of the most active law firms for representing venture-backed companies in M&A and exits. So we have a slide deck, but I think the presentation will be a little bit more kind of a panel format and more of a discussion. And so, but we will, first I think talk about kind of what 2024 looked like and a little bit of an overview there. And then what we're seeing, what kind of the outlook looks like for 2025, and I think we're positive or optimistic at least that 2025 is going to be a improved year in terms of activity. And so as we see more activity, I think we're going to talk a little bit about best practices for internal and external counsel interaction. And so with that, let's just kind of go into our panel discussion here. So 2024, I guess we could talk a little bit about, maybe John, I'll look at you first. As 2024 comes to a close, what did 2024 look like, and what are some of the themes that we saw in M&A activity?
Thanks, Ryan, and very much appreciate everyone taking the time to join us on this presentation this morning. And just so that everyone's aware, as mentioned, I'm John Olson. I'm a partner in the M&A group, and I sit up in San Francisco. But I have had the privilege to do a fair amount of M&A deals out of San Diego. So very privileged to be talking to you all today. So I think that thinking about what 2024 looked like is you really have to understand, kind of where we've been over the past few years. In the beginning of the pandemic, really 2020 through early 2022, we saw really an all-time high M&A activity in tech and life sciences. There's a wide variety of reasons for that. A lot of risk capital, a lot of increased savings when consumers weren't buying high cost goods and started saving more, and those savings amounts went to more risk capital, and there's a lot more investment in tech and life sciences. That's one of the stories. There are certainly a lot of other ones. That story shifted very dramatically in Q3 of 2022. Where from that point through 2023, the M&A markets in this particular sector were essentially moribund. There were certainly deals being done, but they were deals done out of necessity rather than out of choice. And the markets were pretty quiet. 2024 has been the story of I would say a partial thawing. Some of the impacts that we saw in that kind of downturn and some of those headwinds have eased up a bit. the interest rate headwinds in particular, with the Fed having raised rates dramatically in the prior period. We've now seen obviously the Fed having first paused their rate hikes and then now embarking, tentatively on a plan of easing those interest rates. So that is normally correlated with more M&A activity. We're also seeing on the private market side of things, the valuations are steadying in venture finance. For a while they were either dropping dramatically or companies were just avoiding raising money altogether if they could help it, because they didn't want to face down round cuts in valuations. But we're seeing, I think, more private market valuations steadying through 2024. Public market valuations are steadying or increasing depending on the sector. I mean, we've all seen, obviously, the stock market has done as a whole has done tremendously well over the past year, but that has been, I think, very sector specific in terms of the impact on valuations. And we are still seeing, though, and maybe this is one of the biggest and one of the most interesting of the headwinds that we're still seeing in 2024, towards the end of 2024, are the regulatory headwinds, mostly antitrust and competition issues. Although there's also for cross-border deals, there's also issues around CFIUS and foreign direct investment laws throughout the world. But we'll talk a little bit more about the regulatory stuff as we get into the presentation. But I think overall, as I said, we're seeing a return of quality deals in the life sciences and tech sector, deals that are done out of choice rather than out of necessity. And some of the big buyers are starting to come off the sidelines. So that's all, I think, very promising as we look towards 2025. But maybe I can actually ask my colleague Jen, if you wouldn't mind fleshing out a little bit about the other types of deals that we have continuously been seeing, the deals that are more out of necessity rather than out of choice.
Yeah, of course. So yeah, as John mentioned, we're still seeing deals out of necessity that we're seeing for a number of reasons that I wouldn't say are specific to 2024, but it's the trends are that the companies are running low on cash or having a challenged business model, so need to be creative as to what they're doing based on where their business is at. What we're seeing from those deals are more asset sales, more carve-out sales, which is a means for them to raise funds. A lot of times, a lot of these deals are often more complex, despite having low dollar values, which is something we have to be creative about. The creative use of deal structures are also something that we're seeing, which is reverse mergers with public companies that have significant cash balances, or merger of equals between two private companies. What we're seeing from these structures are that companies need to scale, or they're able to have leverage their business for growth as a way to get new capital, and that they're getting new capital either from private markets or from going IPO.
Yeah, great. And John, I know you sort of spoke earlier a little bit about how valuations are starting to normalize a little bit, and we have seen some stability. But what have we seen is there's sort of been, kind of a disconnect between valuation, and there's been a lot of volatility in valuations. And how are companies addressing that volatility in valuations, and as we look at deal structures?
Yeah, I mean, it's a great question, Ryan, because in some ways it's very deal specific. I think that and it depends on if you're talking about public companies or private companies, private deals. One thing I think a few themes though that do pop out are we are seeing increased emphasis on earnouts and milestones in terms of structuring the consideration. And so, obviously, when you're talking about a drug development business, et cetera, it is by far the norm, and has been for a very long time, to have milestone-based payments based on development and even putting aside commercial success. But I think that you're seeing that same technology, that same deal technology of using earnouts or if in the public market CVRs, but thinking about ways to bridge valuation gaps. So we are seeing that, and increased focus on from buyers on reducing risk around the revenue expectations or earnings expectations that their sellers are trying to say that they would that they expect, but it's kind of a way of making the sellers put their money where their mouth is in terms of how the business is going to perform post closing. We're also seeing increased use in stock consideration, particularly for private companies, but also I think we also expected for public companies as well. The advantage for private companies to use stock, private company acquirers to use stock is that they can avoid using capital that is earmarked for operations and growth, and instead use their own stock. One of course, the biggest pitfalls to that is if you are on the acquirer side and you're offering your own stock, you're a private company, is convincing the sellers as to what the value of your stock is. And oftentimes we'll actually see when you have two private companies, often both venture backed, let's say, and they may decide, hey, we're just going to use other metrics for figuring out a relative valuation between the two companies, and so focused on saying, hey, the target company is worth 10% of the combined company, and focusing it as a percentage rather than trying to drill down on the dollar amount that would be used, and then translating that into stock. So that's a trend we see in terms of private companies, and again, that's the big advantage to that is keeping that cash that you could you would otherwise spend on the acquisition, and being able to put it to work to grow the combined business for the benefit of all the stockholders. Public companies, again, they and this is maybe not something that we've seen as much of a trend as with private companies, but certainly it's something we expect, which is that they can put their recent appreciation in share price to work without doing actually an offering of stock. So that's I think a big advantage to them as well.
Yeah, great. And maybe stepping back just a step or two, and maybe I'm looking at Eric here. Eric, you've got a bunch of experience over the last few years in different companies as as internal counsel, and in looking and seeing M&A activity. And I guess, what have you seen like driving deals, and particularly in the life science space? I know you're active there.
Yeah, just for folks' background, I started my career at Latham as an M&A and securities lawyer, and then spent some time as associate general counsel at GenPro before we sold it to Hologic, and then spent about a decade at Genmark before we sold it to Roche, and I'm now working with the Gunderson team very closely as outside counsel for Singular Genomics. Very consistent, to answer your question, Ryan, in terms of what I've seen on the inside based on what sort of John and Jennifer laid out in terms of sort of the different M&A environments. During my time at Genmark, when we sold Genmark to Roche in 2021, obviously it was a very difficult time during the pandemic, but was very robust in terms of growth for diagnostics companies given the pandemic. And then more recently, we're seeing a much more challenged market for earlier life science companies, and particularly in the tool space. In 2021, the pandemic sort of fueled growth of early stage companies that were in the diagnostic space, that were able to be nimble and pivot and address the pandemic in the ways that Genmark did, for example. Genmark was fortunate enough to make the decision to develop a COVID test in 19 days and was one of the first 10 to get it through the FDA through emergency use authorization. And there was a ton of investment from both strategics as well as, the public government funding and clearances through the FDA that made that area particularly strong and robust during the pandemic. You saw companies like Roche obviously acquiring Genmark, Thermo Fisher acquiring Mesa Biotech to fill gaps in their product offerings that some of the smaller companies were able to more quickly address during those difficult times. On the flip side, more recently, I'm definitely seeing a much more challenged M&A space. You're seeing companies in our space with significant valuation erosion, companies trading in the public markets less than the cash on hand. One could argue that perhaps there was a little bit of over exuberance in the diagnostic space during the COVID pandemic, and since it's receded, we may have seen a bit of a pendulum swing in the other direction. It sounds like folks are viewing 2025 to maybe be a more normalization time period. But I think you're seeing deals currently, at least from my experience, a little bit more out of necessity, companies cutting costs, looking to find solutions to get to a more favorable financing environment. And so you are seeing those sort of more nuanced deals that Jennifer mentioned in terms of companies being creative to extend their cash runway, things more like mergers of equals, take private transactions, those types of things.
Yeah, thanks, Eric, for that. And I know we sort of, we see this in the news. We've seen it definitely recently with the new administration, but we've seen talk about, what's happening at the FTC and what that regulatory action looks like. And I guess, how are these regulatory changes and how are they influencing how they influence M&A activity over the last year or so? Maybe John, you could start. Or maybe Jen. Well, yeah.
Do you mind if I jump in and then John add anything? What you're saying, I know obviously we've worked on some deals together, but some apart, of course. So I think what I'm seeing a bit is regulatory challenges don't just impact deal risk, meaning like would the deal fall apart, but it's also posing a lot of financial challenges for cash burning businesses during the interim period. So what we're thinking about between signing, after signing, and pre-closing, there's some concerns. We're seeing those concerns specifically for life sciences and med device businesses with significant cash flow costs. And so I actually worked on a deal recently for a client based in San Diego that was a medical device company. This was a big concern with us because we knew it would be a longer extended period. And so we want to be thoughtful. We did that in a few ways. So one of the ways we did that was how we looked at the drafting of the interim operating covenants, which is what would be governing our actions, what we couldn't do between that period and without getting the consent. So there was kind of one part of us where we were trying to look at this, we always do in deals, but the focus of the timing were to make sure that our clients are able to continue their business as they need to in this time period. Without having to go to buyer and possibly slip up any gun jumping violations. And so I think that's something we're really focused on right now. There's also an issue around funding. And so during this, post-signing, pre-closing period, in addition to thinking about the interim operating covenants, we also often need to pre-negotiate where the funding is going to be coming from during this period. We often see this, it can be either the funding is coming from the buyer and that's something we pre-negotiate, or we're pre-negotiating ability for us to raise this money in that period from insiders. And so it's just a thought of where is that coming from, especially if there's significant cash development costs. And then there's also limited options for remedies. So it's harder to allocate risk covenants. And so buyers are sometimes reluctant to pre-agree to structural remedies, and how that would be divestment. So because of that resistance from buyers, we're actually having to rely on breakup fees to allocate risks and to align incentives, since we can't just rely on actions based on what we agree to within the covenants. And then like the last thing I'd add is that since there's longer review periods, it also means there's increased pressure on the target to make sure they have breathing room for all the actions that we talked about with respect to the interim operating covenants. John, is there anything else I guess you're seeing in this space?
No, yeah, but I think you basically hit it on, Jen. But I think that it's worth emphasizing that I think there's a lot of attention that's paid to in the kind of deal environment in general. It really kind of for very many years around allocation of risk on antitrust. But I don't think that there has been necessarily as much focus on how you fund a cash burning business in between when you have a longer regulatory period. So obviously there are deal practitioners who've done it in lots of deals, but it does seem to be that that's an area that really does require some pretty creative thinking, very much upfront when you're discussing letters of intent and term sheets at the beginning.
And I think the only thing I would add is actually with our life sciences clients, when we know this, we actually do a lot more check-ins on like how things are going during this time period, or if there's any changes, what procedures we're putting into place, given that they have these restrictions, but also needs to operate their business. So how much they're communicating with the buyer during this time period on sell side deals. So it's something we're actually a lot more involved specifically for our life science clients given the climate right now.
Yeah, interesting. That's it's interesting to see these changes and seeing how practitioners are allocating or deal structures and kind of allocate risk on these longer periods. And I know we're talking about deal structures, and I know we've been seeing recently just the drive for talent in AI or like genetics and things like that. But I guess are we seeing? And I think we've probably seen some different deal structures as acquirers are trying to get talent for their AI to develop AI technology. And maybe we could talk a little bit about some different structures we're seeing in that space as it relates to AI and bringing AI tech in-house.
Happy to take that, Ryan. So yeah, 2024 may be one of the more interesting developments in kind of the tech space in terms of doing M&A. Has been the approach to what I think I like to call the mega acquihire structure. So that started with Inflection, with Microsoft's acquisition of the team at Inflection. Amazon, followed up not too long later with Adept. And then the big one that made, I think, a really big splash, not just in M&A circles, but I think it was the broader press, Wall Street Journal, New York Times, et cetera, really dug in, which was the Google's kind of, I would say, hiring of the Character.ai team. And so what all of these deals had in common is that they used a structure that was invented. My guess is probably 15 years ago, maybe 20 years ago. But it was the purpose of that structure, which we call the acquihire structure, is typically to acquire a team that is, usually has a lot of engineering or other technical talent, and the business wants to get the acquirer wants to get that team working, but they don't really want the business that the team has built up to that point. So it's oftentimes used for what I would call a failed startup. And so the way that those tend to be structured is there's no entity that's acquired. There's usually no assets acquired. There is usually a license. Sometimes that would be exclusive, or sometimes a non-exclusive license to the IP. And then there would be a waiver and release where the entity would and its stockholders would waive any claims against the acquiring entity with respect to tortious interference with contract or business relationships, et cetera, so that the buyer would feel comfortable hiring the entire team. And so it was a structure, again, that was typically used for very, very small deals. And probably not a lot of attention was paid to it. What's interesting about these three deals is that that they used essentially this structure to acquire these teams for, you know, in at least one case, eye-popping numbers. So I think Character.ai, it was announced that the value to the cap table was 2.7 billion. Inflection was, I think, 650 or so. Adept was lower at 330. And that's actually putting aside the value that was given to the employees. So a lot of in those deals, a lot of the employees would also get, you know, pretty big incentive equity pools, et cetera. So that's a really, you know, interesting, you know, development. I think that one of the, you know, the biggest question, of course, is why are they doing this? Why not, you know, but why did, you know, Google not buy Character.ai? And, you know, while I don't think you get this answer from any of those acquirers as to exactly this reason, I think the speculation broadly in the press and among practitioners is that these structures avoid the technical trigger for filing HSR, you know, filing for antitrust approval from the, you know, the FTC or DOJ under the HSR Act. And so because the HSR Act only calls out an exclusive license as a form of acquisition rather than a non-exclusive license. It doesn't mean, and I think everyone has a sense that this doesn't mean that these deals are free from antitrust scrutiny, but from a procedural perspective, not having to do a filing as a prerequisite for closing, I think puts those acquirers in a much better position vis-a-vis, you know, from a procedural perspective, vis-a-vis any potential challenges from the government. So that, and I think that, you know, so that's the reason why they wanted to do it. The reason it works really well, I think, here in this specific area, and it might not be, you know, replicated in other sectors, is that so much of the value of these companies, and particularly in the early stages, is in the brains of the researchers who have spent so much time figuring out how to make these businesses and this technology work. So it's somewhat of a unique situation where, you know, we might not. I would be skeptical about seeing this sort of structure used in a lot of other contexts, but at least for now, it was interesting that the practitioners on these deals came up with the structure, because it does seem to work particularly well for these deals.
Yeah, thanks, John. So I know we're talking about structures and what those look like, and some of the interesting things we're seeing, you know, and we've seen in 2024. But maybe, you know, looking a little bit more at process, you know, and Eric, maybe you could jump in on this one. What have you seen as like common deal risk or friction as you're running the deal from your perspective, and how have you been able to address those kind of proactively?
Sure. Thanks, Ryan. You know, obviously these deals work somewhat in phases, and at the outset is kind of the obvious one when it gets to sort of the question of valuation, and trying to just get a meeting of the minds of the parties as to what that might look like and whether it makes sense to continue the process. Once you have alignment sort of on that high level valuation, often then the real legal work begins, and the diligence process commences, and you start to have to make sure that you understand from a target's perspective what the key sort of operational execution risks and capability questions that are going to be asked as part of the diligence process. Obviously, looking at the plan for the company, and as an acquirer, trying to pressure test and understand what the risks are, what the likelihood of successful execution are, and really working internally and identifying your internal team of the folks that are going to need to be involved and prepared to answer tough questions about what the company is going to be able to deliver on, and what the risks might be and how those risks have been mitigated. In my experience, the most touchy subject is often IP related in our space. In a number of deals internally, those have been some of the most focused on types of questions, and often related to IP litigation risk or FTO assessments. And so really understanding early on, and even before the M&A process commences, sort of the company's IP position, the market position, and having defined those positions with both internal and external counsel to be able to articulate strong positions relative to risks that might be in the environment. And then identifying and working through those questions in advance with your team to make sure that you understand at what point in the process it makes sense to share different levels of information, what type of information is not going to be shared, and sort of staging that appropriately along with the sort of status of the deal. And having those positions well defined and understood and communicated is often critical to balance a couple of competing goals, which is obviously making sure that a potential suitor is comfortable with the positions you've established, but also not moving too far down the line where you potentially put at risk waiving attorney-client privilege relative to some of those issues.
Yeah, thanks. Yeah, thanks, Eric. Super insightful. And we're talking about some of the 2024 and things are looking better. We've definitely better than 2022 and 2023. And as we're looking at 2025, I guess maybe we can talk a little bit about what our outlook is, and is there, whether there's a consensus about where things are heading, and maybe we can talk a little bit about what the new administration and the FTC will look like for tech and life science.
Yeah, maybe I can jump in there, Ryan. I think that I think most folks by now probably guessed that we're reasonably optimistic that there will be more deal activity. I mean, I think that the trend lines are going, I wouldn't say up and to the right, but certainly steady in terms of showing reducing headwinds in the deal environment, and maybe some tailwinds. The one I would say biggest question mark is actually on the approach to regulation. I think it's no secret that there has long been a view that Republican administrations tend to favor a deregulatory environment, tend to have somewhat of a lighter touch, particularly on antitrust and competition control. That said, I think the jury is still out on what the Trump administration is going to do here. I think that it's probably safe to say that there probably will be more crypto deals. I think that the writing is on the wall that the SEC's enforcement agenda vis-a-vis crypto is certainly going to be on the wane. On the other hand, there I think has been a very strong signals from the incoming Trump administration that they're going to take a harder view on big tech in particular. There was yesterday, there was a nomination or announcement of a nomination of Gail Slater, who had been working with Lena Khan at the FTC with a very skeptical eye on the behavior of big tech. So Gail Slater was announced as the head of the DOJ antitrust division. So. And it's also been reported that she was advising JD Vance during the campaign. Vance has, during the campaign, also spoke approvingly of Lena Khan's approach to big tech. So I think that, even if, other sectors are, might expect a looser merger control environment, I think that again, the jury is still out in terms of what that's going to mean for the tech sector. Other sectors, maybe interesting to think about whether or not the influence and kind of would say the kind of negative views of the larger pharmaceutical companies that RFK Jr. Has, and whether or not that might have some influence in the approach that the regulators take with respect to antitrust and competition. That's probably more speculative, but I think that at least right now, we probably can't really tell how that's going to play out. So watch this space, I guess, in terms of how the regulators are going to approach various sectors of the economy.
Great, thanks. I mean, do you think we can feel some optimism as compared to where we've been the last few years? Our fingers crossed? I mean, how are we feeling overall?
I do. I do, because look, yeah, gut feeling. I do, because look, it's not like increased regulation during the Biden administration cut off deal making altogether. I think, look, if we had a very permissive regulatory environment during 2022 or 2023, I still don't think you would see very many deals. So it's one headwind factor among many, and I think the tailwinds of assuming that interest rates continue to drop or stay steady, and thinking about all of the other kind of tailwinds, I think that we're going to see steady or more M&A activity. I think would be the consensus. Although call me up in a year and hold me to it.
I think we said the same thing last year, just to be honest. So
yeah, it's probably true.
I think everyone was optimistic last year too, but I do feel better about 2025, and I think I've seen some increased discussion on the M&A front. So I have some optimism in my belly. But as M&A kind of picks up, and hopefully, right, we say, I think the interactions between internal and external counsel are going to become that much more important as we really get busier. And Eric, you've got great experience on kind of actually being on both sides of the both internal and external. But what have you seen as kind of effective ways for internal and external counsel to work together on M&A, and maybe you could share some insight there?
Yeah, and I think it's probably not necessarily M&A specific, but I think I've been fortunate enough to have very strong communication and partnership with the folks on the outside that I've worked with when I've been in-house. And I think that is something that even when I, enter a new position, oftentimes the law firm that has represented the company historically may have taken them through an IPO or fundraising, and have developed relationships with board members and management. And so really fostering that relationship and communication and partnership focus is something that I've tried to make sure is instilled in the places I've been. And that sort of leads to, of course, outside counsel and in-house counsel really understanding a good understanding of the business. Where's the business now? Where's it going? What does the market look like? So that when an M&A transaction does come through, the outside counsel and the in-house counsel are aligned in terms of sort of how to address that in the overall context of the business, and really understand the market and the relationships that need to be developed as well as utilized as part of the M&A process, which is obviously a critical point of focus during an M&A transaction. In terms of working together, in my experience, I've tended to have a pretty hands-on approach. I think part of that is probably the history of sort of the practice I had when I was a private lawyer, and the fact that I really enjoyed that part of the job. And those of us on the inside don't always necessarily, depending on the company you work for, engage in M&A every day. And so it's really something I've just sort of migrated towards personally. But in terms of working with outside counsel, when those transactions do arise, I think it's really important to have an internal person who understands M&A, ideally with past experience, and really be the quarterback internally for the company and the conduit for information flow with external counsel. There's everything from, of course, the deal documentation, business points that need to be negotiated, diligence coordination, and a lot of that is more than a full-time job when they do arise. And so I think that communication with external counsel is really critical. I tend to rely on external counsel during the M&A process to handle the deal documentation largely, for example, whether it's an acquisition agreement, disclosure schedules, those types of things, but be the point person for information flow between the business folks and all the operational teams, and the external counsel, as well as sort of diligence coordination, documentation that is part of the diligence process. And I tend to try and be involved in just about every communication that occurs between sort of the business folks as well as the outside lawyers, just because I believe that the most current information is sort of critical in terms of all the activity that needs to happen outside of the documentation, in terms of conversations that need to occur, deal status, understanding how positions are being communicated among the business folks as well as the outside attorneys. And so that's really something that I try and work with outside counsel to allow them to take the heavy hand of some of the more time consuming and very difficult work of the documentation that needs to get done, and try and focus my attention on sort of working the relationships, working the positions and the strategy, and sort of playing the quarterback between the company and the counsel that needs to move things forward.
Yeah, I think at least in my perspective, I've seen the best outcomes where external counsel, outside counsel, and internal counsel are sort of locked arm in arm on the deal, right? And there's a lot of communication between both of them. And then I just think, from our perspective, it's great to have someone in-house that has sort of the context about, what the important business points are, what communication is happening at the company. And so I think, like you're saying, Eric, some of that is, I think, really helpful for us as we're looking at the document. Okay, how do we negotiate the merger agreement? What do we need in there? And we're getting the context from you and what's important from the company, and some of those communications that are happening that we don't always see. So I think that's something I've seen. I don't know.
I think
Jen, give additional input.
Part of my migration of going from the law firm in-house is sort of being as much a business person internally as a lawyer, and sort of being able to bridge that gap and understand risk profile, and be able to make some calculated decisions about what's truly important in a deal to get to the end result that you need, and where some level of risk may be appropriate to accept. So
yeah, it may be one of the things I think I know about you, Eric, is that you're very hands-on when you need to be, and like to be part of discussions in certain cases with counsel on the other side, et cetera. I've seen a wide variety of different approaches from our clients in terms of preferences. Sometimes people like to use outside counsel as kind of a shield to make sure that they're not kind of inundated with direct requests from the other side, or that they maintain a little bit of kind of the voice outside the room posture. So I don't know how maybe Eric, how you've come to your style, and how you think it works well for you.
Yeah, I think some of it is personality, some of it's probably history, but in some of the deals I've worked in, they've been part of processes with multiple parties involved. There's oftentimes a special committee that may have separate counsel. There's financial advisors. There's obviously a whole host of folks. There may be multiple financial advisors. There's different relationships with different board members, and there's different communications happening. And from my perspective, having my finger on the pulse of how certain positions are being taken and communicated by outside counsel, as well as the business people, help me digest in ways that sometimes, sometimes it's not the words you use, it's how you say it, or some cues that are given as part of a conversation that help you evaluate a strategic decision that might need to be made as part of facilitating the deal. And so I tend to insert myself pretty significantly in the process, but it's more on the communication side, I think, and understanding, so that I can advise our CEO, our CFO, and others in the board about how I'm viewing the situation. And I think that is extremely important to me as I'm providing guidance to the company.
Yeah, great. And maybe just from we talked about outside counsel, and we definitely we're pushing the documents forward, and a lot of drafting. But maybe just from a personal standpoint, like, what do you see are the best ways that external counsel can provide like real strategic value besides just drafting documents and negotiating merger agreements and things like that?
Yeah, I think it gets back to the prior point we discussed a lot, which is sort of that collaborative partnership style that I've tried to foster with the folks I've worked with. I think the business understanding from the attorneys is extremely important, and that helps me think through a lot of those discussions, whether it's when to have it, who to have it with, how to move a issue forward. And really being a business partner and a sounding board with outside counsel to evaluate options, make sure you're evaluating risk in the same way. So I really do value that relationship significantly, because they are sort of, I tend to don't have the companies I've worked with have a significant sizable legal department, and so it's something where that trusted advisor is really critical to me for me to be as effective as I think I can. So it's everything from strategic brainstorming. It's the fact that folks like John and Jen and you, Ryan, are doing deals on much more frequency than a lot of internal folks, and so understanding how deals are getting done in the current environment, what the market's like, how issues have been dealt with in other contexts that may be similar, and what options might exist other than just thinking about it on your own. Those are very important facets of the relationship, I think. And also, as I mentioned earlier, a lot of the law firms I've worked with have had prior relationships with board members, with investors, with financial advisors. To the extent you need to involve other law firms to represent different constituencies, the folks that have worked with you, for example, in the past that you've facilitated deals with, those relationships are important to bring to bear to solve issues quickly and to get to the best outcome for the company.
Yeah, and maybe John or Jen, you can maybe same question, and what have you seen as kind of your role? I mean, you guys are doing way more M&A than me, but what do you kind of see as your role as outside M&A counsel on providing strategic value?
Yeah. So I think that, and I'd love to hear Jen's views on this too. I think that two things come to mind. And one is understanding the rhythms of the deal, and understanding kind of where the pitfalls tend to be from a pattern recognition perspective, and feeling whether or not the deal is moving fast, moving slow, where are they, things that might jump out at you at the last minute that you're not prepared for. I like to use the metaphor when people ask me, kind of what I do for a living, is that I feel like I'm a river rafting guide. Where I, going down the rapids is always going to be a pretty hairy experience. Thrilling, yes, but also dangerous. And so if you're in my raft with me, it's my job to tell you, hey, like, now we all need to row really hard in one direction here or there. By the way, there's a rock over there, or there's an eddy over there that you have to avoid. The point is that, like, it's just as intense for us as outside counsel as it is for in-house counsel, but we've seen it before, and so we can help you kind of judge those sorts of potential pitfalls. The other thing that pops up to my mind is thinking about relationships. One of the things that's kind of neat about our particular sector of the economy, in the kind of the innovation economy, right? The life sciences, technology, emerging companies, founder-led businesses, et cetera, is that there are a lot of repeat players. There are a lot of folks that are, this isn't their first time through, this isn't their first company. There are a lot of investors that you will see in particular across the various sectors. And one of the really nice things about our practice is that we get to see a lot of the same people, a lot of the same faces over and over again, and we can develop a certain level of trust with those actors, and of course also with a counsel on the other side, right? Like, again, because this is again somewhat of a more focused area of the economy, we tend to see a lot of the same faces sitting across from us, and can develop that level of trust. So, and that, I think, helps considerably in terms of navigating, around the kind of the sharper points of deals, is being able to have that trust. So I don't know, Jen, if you have anything that you want to add on any of that.
Yeah, just adding on it a bit, and obviously we differ a lot on deals with, like, Ryan from, like, the corporate partner on the transaction, but I do think a lot of times what we can be helpful with is also board dynamics. I think there's sometimes there is outside, board has their own counsel, and so we can be really helpful of one if there's, sticky points, trying to hash that out with the, management council, board council. I think it's really important, something we do. And a lot of times we do deals with them so often, either when we're actually selling or buying the company with them, but also just in terms of board representation, that's very, our investor representation. I think it would really be helpful of being like, hey, we know exactly what you want. Like, on a deal right now, basically, I make sure every turn we're providing them with the draft of the markup. I have my own issues list specific for them to make sure we walk through, like, I know you care about this, is where I'm pushing, and kind of taking that off of Eric's plate. And so he doesn't have to really worry about making sure the board is okay with the definitive agreement. That's more my job. And I will, put him in to talk when needed. But I think that's one way that we're trying to, like, help, is actually taking the deal focus for dynamic kind of off the GC's plate.
Great. Yeah, thanks, Jen. Appreciate that. I know we're getting down on time, but I think one last thing I thought we could just chat about, and more question for Eric, and how he thinks about his role in kind of assuring that the M&A process aligns with the company's long-term objectives. And we kind of know what they are, right? It's maximizing shareholder value, but I think you have better context from your perspective. So maybe talk a little bit about that.
Yeah, I think, from a governance perspective, having, from my perspective, I think it's always sound judgment to have a financial advisor updating the board on a regular basis as they evaluate their going forward plan. in their long-range plan, not only just to pressure test assumptions regarding markets and things like that, but also to provide an external context related to market developments, strategic activity that are occurring, what they're seeing in the market, what opportunities might be there, what the financing environment is like, either currently or expected in the future, valuation, things like that, to make sure that the board is getting a holistic understanding of kind of the market, the going forward plan, and how best to achieve the result you just indicated. I think it's also, you know, from a growth perspective in terms of long range plans for companies, the GC or the legal department, having a very close relationship with your business development team is another thing that I think is pretty critical to help the company from the legal side's perspective to achieve its long-term goals. Understanding where areas of growth may be and whether there's opportunities out there from an acquisition perspective to fill gaps or seize on opportunities that might be emerging in order to grow the business, and whether doing so would be easier from an organic growth perspective or an acquisition or licensing perspective. And so I think, you know, both the business development side on the growth and acquisition side, as well as understanding, you know, the financial and market dynamics at the board level from a holistic approach from a seasoned financial advisor on a regular basis are pretty important topics that I try and make sure are worked into our regular cadence on a board schedule to make sure the board is consistently taking a look at all options that the company has for achieving maximum value.
Yeah, I think it's a good way for the board to really actually make that assessment of making the decision that's in the, you know, maximizes long-term shareholder value. So that's thanks, Eric. That's I think I'm winding there as well. So I know we're kind of up on time, and Megan, I don't know, we didn't see any questions, but you know, we could probably have a minute or so for questions. People have any questions? But
Yeah, I don't see any questions either on my end.
well, yeah, we appreciate this time to this last hour we had to talk to you all and share kind of what our insights have been for 2024 and what 2025 looks like, and you know, a few tips and tricks. So appreciate the time.
Thank you.
Thanks, guys.